Imagine this for a moment. You've finally found the home you want. You're excited, maybe a little nervous, and you're already picturing where the couch will go. But then the mortgage conversation begins, and suddenly you're hearing terms like A or prime lender, monoline, lender, private financing, GDS, TDS, and you're thinking, hold on, who is actually lending me the money? And which one should I trust? Most Canadians don't realize this, but choosing the wrong lender can cost you tens of thousands of dollars over the life of your mortgage, even if the interest rate looks good at first glance. Today, we're breaking down the entire lending universe in a way that's simple, clear, and practical. By the end of this video, you'll know exactly who lends you the money, how mortgage brokers fit into the picture, what banks look for when approving you, and which type of lender is the best match for your financial situation. Welcome back to Property Geek, where smart buyers get smarter. If you're new here, I'm Mark, and this channel is all about helping you navigate the Canadian real estate market with confidence. In our first video, I promised we'd dive deep into lenders and mortgage brokers, and today we're going all the way in. Let's get started. When most people think about getting a mortgage, they picture walking into a bank and talking to someone behind a desk. But in reality, Canada has a much broader lending ecosystem. There are four main categories of lenders, and each one works differently. First, we have prime lenders, which include the big banks you already know. RBC, TD, Scotiabank, BMO, CIBC, National Bank, as well as credit unions like Meridian, Duca, and Coast Capital. These lenders offer the most stability and the lowest interest rates, but they also have the strictest approval rules. Next, we have monoline lenders. These are companies that specialize exclusively in mortgages. They don't offer checking accounts or credit cards. Mortgages are their entire business. Examples include First National, MCAP, RFA, and Equitable Bank. Because they're focused, efficient, and competitive, they often offer excellent rates and strong customer service. Then we have lenders, also known as alternative lenders. These are trust companies and specialized mortgage institutions that work with borrowers who don't quite fit the strict criteria of the big banks, maybe because of credit challenges, self-employment, or higher debt ratios. And finally, there are private lenders, individual investors, private lending companies, and mortgage investment corporations. They're the most flexible, but also the most expensive. Private lending is usually a short-term solution for buyers who need fast approval or have unique circumstances. Now let's talk about interest rates, because this is where the differences between lenders really start to matter. After several Bank of Canada rate cuts, most prime lenders, the big banks and credit unions, are offering 5-year fixed mortgage rates in the 4% to 4.5% range. Variable rates are also hovering around 4% to 4.6%. These lenders are stable, predictable, and ideal for borrowers with strong financial profiles. Monoline lenders tend to be slightly more competitive. Their rates often fall between 3.8% and 4.3%, depending on the product and the borrower. They're able to offer these attractive rates because mortgages are their only focus, and they don't carry the overhead of large retail banking operations. B-lenders, on the other hand, typically offer rates in the 7% to 9% range. That might sound high, but remember they're taking on borrowers who may have lower credit scores, higher debt, or less traditional income. Their flexibility is what you're paying for. And then we have private lenders whose rates usually fall between 10% and 14%, plus lender fees and sometimes broker fees. Private lending is not meant to be long-term. It's a bridge, a temporary solution while you improve your financial profile or prepare for refinancing. A lot of people assume mortgage brokers lend money themselves, but that's not how it works. A mortgage broker is essentially a matchmaker. Their job is to understand your financial situation and connect you with a lender that fits you best. A good broker compares rates from dozens of lenders, negotiates on your behalf, and packages your application in a way that highlights your strengths. They guide you through the entire process, from pre-approval to closing, and help you understand the fine print. Most of the time, you don't pay the broker. The lender pays them a commission for bringing them a qualified borrower. The only time you might pay a fee is when you're working with a private lender or when your file is unusually complex. Think of a broker as your personal mortgage strategist, someone who knows the entire lending landscape and helps you navigate it. Now let's talk about what actually determines whether you get approved for a mortgage, especially with prime lenders. The first major factor is your credit score. Banks typically want a score of 680 or higher for their best rates. Scores between 600 and 679 can still work, but your options become more limited. Below 600, you're usually looking at B lenders or private financing. The second factor is income stability. Banks love predictable, consistent income, full-time employment, 2 years of steady earnings, and clear documentation. If you're self-employed, you'll need tax returns, notice of assessments, and sometimes business financials. But one of the most important and most misunderstood factors is your debt-to-income ratio, which is measured using two formulas, GDS and TDS. GDS, or gross debt service ratio, looks at how much of your income goes toward housing costs, your mortgage payment, property taxes, heating, and half of your condo fees. Banks generally want your GDS to be 39% or lower. For example, if you earn $6,000 a month, your maximum allowed housing cost would be 6,000 times 0.39 is equal to $2,340. So your mortgage payment plus taxes and heating must be $2,340 or less. TDS, or total debt service ratio, includes everything in GDS plus all your other monthly debts like car payments, credit card minimums, student loans, lines of credit. Banks want your TDS to be 44% or lower. Using the same income example, 6,000 times 0.44 is equal to $2,640. So your total monthly debt obligations must be $2,640 or less. Even if you have great credit and a big down payment, high debt ratios can still lead to a decline. This is why some high-income buyers are surprised when they don't qualify. Their existing debts push their TDS too high. Let's take a closer look at the strengths and weaknesses of each lender category. A lenders offer the lowest rates, the best prepayment options, and the strongest consumer protections. They're ideal for borrowers with stable income, good credit, and manageable debt. The downside is that their rules are strict, and they're not always flexible with self-employed borrowers or newcomers to Canada. Monoline lenders are mortgage specialists. They often offer competitive rates and excellent service, and they don't pressure you to bundle products like credit cards or bank accounts. The only drawback is that they don't have physical branches, which some borrowers prefer. B lenders are more flexible. They accept lower credit scores, higher debt ratios, and less traditional income. They're a great option for self-employed borrowers or people rebuilding their credit. The trade-off is higher interest rates and sometimes additional fees. Private lenders are the most flexible of all. They can approve files quickly, work with unique properties, and help borrowers who need short-term solutions. But their rates are the highest, and their terms are usually only 1 year. Private lending is a temporary tool, not a long-term plan. So, which lender should you choose? If you have strong credit, stable income, and low debt, a prime lender or credit union will almost always give you the best long-term value. If you want competitive rates and don't need a physical branch, a monoline lender might be your best match. If your credit score is below 650, or if you're self-employed with lower taxable income, a B lender can give you the flexibility you need while you work toward qualifying with a bank. And if you need fast approval, have a unique property, or are in a temporary financial challenge, a private lender can help you bridge the gap until you're ready to refinance. If this video helped you understand the world of lenders and mortgage brokers in Canada, make sure to hit that like button. It really helps the channel grow. And if you're new here, subscribe to Property Geek for more clear, practical, and honest real estate guidance. And even though today's examples are based on the Canadian system, the core principles of mortgage approval, credit, income, debt ratios, and lender types are very similar in the United States and many other countries. So no matter where you're watching from, these insights can help you make smarter decisions. Thanks for watching, and I'll see you in the next episode.